The immune system of the economy is extremely healthy. We printed $6.3 trillion. We have a lot of stimulus still to come out over the course of the next 3 years, and that's an immune system thing. That just means it's hard. The credit situation, almost every corporation refinanced their credit to much lower yields. Home buyers, they're not suffering because they have fixed rates at much lower. There's no more refinancing going on. This is not a systemic issue. And so from a football perspective, basically, if you've got a team and all of a sudden your 10 best players get injured for 2 weeks, the spread's going to shift dramatically and you're going to be an underdog in all those games because you're missing your 10 players. I think we're at a very different point, and people should be focusing now on the opportunities and realizing that just like the Fed missed it last year and they should have been tightening, and at some point we'll reach equilibrium, and it'll be through those real 2-year rates that you start to see a turn. And I think that's going to happen sometime over the course of the next 2 months because I think the inflation data is going to come down sharply.
Hey everyone, thanks for watching this episode. If you enjoyed this episode, make sure you like and comment below. And to find future episodes in your feed and push notifications, make sure you subscribe. And if you click the little bell, you'll get every new episode as it's released. Thanks again for watching. Today, I'm sitting down with Jordi Visser. Jordi is the president and chief investment officer of Weiss Multi-Strategy Advisors, which is a $4 billion hedge fund. In today's conversation, Jordi shares his views on the September 21st, 2022 Federal Reserve interest rate hike of 75 basis points, which is the third consecutive rate hike of 75 basis points, the first time in history that they've done that. We're also going to hear his views on the current inflation rate and where he believes the market is headed over the next few months to a year plus and why. He also discusses Bitcoin, real estate, and more. So sit tight and let's dive in with Jordi Visser. Hey guys, I'm going to take a quick pause to introduce the first sponsor on the Jay Gould Show. I am happy and proud to say that this show is now sponsored by Withum Smith & Brown, which is a forward-thinking, technology-driven advisory and accounting firm that is committed to helping big and small companies be more profitable, efficient, and productive in today's complex business environment. Withum now also has a dedicated crypto and blockchain technology team to help early-stage businesses properly navigate all the crypto tax-related matters. I've been using Withum both personally and professionally for nearly a decade for all of my business's personal needs as well. I'm very happy with them and I highly recommend Withum. You can contact Withum by visiting their website at withum.com. Now back to the show. Jordi, welcome to the show.
Thanks, Jay. Glad to be here again.
All right. So as I said in the pre-interview here, we are recording this at 10 a.m. on September 22nd, 2022. I don't typically mention that in interviews, but with Jordi and others in the financial markets, it's important because we're going to talk about timely current events on the market. And so I think it's kind of important for you to understand that. So right now, as we speak, the last time I looked a couple minutes ago, the S&P was down 1.75% for the day, and it's down 21.5% year to date. Last time we spoke, which was April 25th, the market was down about 10% year to date. So let's talk about yesterday's Fed meeting. In yesterday's meeting, the Federal Reserve approved its third consecutive 75 basis point rate hike, which is, I believe, the first time in history they've done 75 basis points 3 meetings in a row. So let's do a recap on that. Yesterday's 75 basis point hike, like I just said, markets initially, they dropped because of, I think, the shift in what they're calling the so-called dot plot, which you could probably explain better than me, which indicated that the Fed meeting over the next 2 meetings will include another 75 basis point hike and then a 50 basis point hike. So that's 25 basis points, I believe, above where Wall Street had anticipated. And, you know, as we both know, investors don't like surprises. So they're kind of resolving that over the next couple of days. All 3 major indexes have dropped initially after the Fed meeting announcement. They attempted to rally midday yesterday, and then they fell off again at the close. And obviously we're down today. So really, we'll start off with this. What does all this mean? Where are we going from here?
I don't know, Jay. When did we do the last? What was the date when we got together last?
April 25th.
Okay. So, and the reason I was asking that is, I think people, as they kind of, especially for people that don't follow markets on a minute by minute basis like we do, in April, the expectations for where the Fed would be at the end of this year were much lower than they are today. So the reason I bring part of that up is part of markets is what's already been discounted. So when yesterday came through, first of all, 75 basis points was expected. So we got what we expected there. They made some small changes to things, but we really didn't have a huge rate move. And from April until yesterday, we had significant rate moves. And the reason I bring that up is we're later in the tightening cycle. And that's one of the things that markets are kind of adjusting to. And so yesterday was not a big surprise to the market. Stocks did fall, and we'll go through one of the reasons why. I tweeted a chart today, which I think describes it well. This gets a little bit into the difference between where we are right now. So if you take inflation expectations in April, compare them to where they are today, expectations have come down sharply from the market's perspective. The Fed has not lessened up on they're still tightening, as you said, 75 basis points, and we basically have another 75 built into the November meeting coming out of yesterday. So what the Fed has done is kind of front-loaded all of the rate hikes and taken it there, despite the fact that most inflation data has already peaked and gone lower. So if you think about where we are, the term that we use for markets, and I know a lot of your audience is in the crypto world, and we'll eventually get into that, the most important factor that I can think of for markets, especially when it's changing dramatically, is not rates. It's rates relative to what the market thinks inflation will be going forward. And right now, the Fed is still raising aggressively while inflation expectations are going down. So real rates have gone up significantly since we did our first get together in April.
Let me just go to this next point that I had for you to talk about. So something I wrote here, I'm just going to read this to you. It says, the Fed talked about pain, right? We have some pain ahead, right? So the Fed keeps mentioning this, and really the only one that's really going to feel this pain, I believe, is going to be the lower and middle class individuals in the country. They're going to likely see the layoffs. They're going to see the hours and their wages getting cut. They're going to have trouble paying credit cards moving forward, debt obligations. As these rates continue to rise, things like mortgage rates are going to keep going up. They've doubled, right? So that's likely to go up if you have the overnight going up. That's a direct impact, I think. And it seems to me that there's going to be a direct impact to home prices, right? We've seen a softening. It's taking longer, home starts, all these kind of things. But like really, we haven't seen it widespread. I'm in the belief that it's really simple. You got a $100,000 mortgage and you're paying 3.5% and it goes up to 6%. You know, your mortgage might have been on $100,000 for every $100,000 your mortgage, it would have been like $400 and some $1,000. That's going to go up. So that means the price has to come down on the house to get the same monthly payment. I think most people look at this as a monthly payment, but also cuts into people's ability to pull down on home equity lines of credit, which I think a lot of people do in this country because they're not making ends meet. None of this is good news in the short term. But throughout the year, I think you've remained pretty bullish because you've seen inflation flattening. And I think I have to assume, and I'm going to ask you, I believe that you believe that the Fed just can't go as far as they're saying maybe. And perhaps a lot of this is just a bunch of rhetoric, hot air, that they're kind of blowing out there. They were originally saying 3.5% to 4%. They're now saying 4.4% and now saying they're not going to have cuts till 2024. They're giving direct signals where they weren't really so direct. It seems like they're really trying to be as hawkish as they can because they're trying to play this playbook of we're trying to get people laid off. They don't say those words, right? But that's what they're trying to do, right? Will they accomplish their goals, or is this just trying to make the company start cutting back? And if they start cutting back and getting restrictive, maybe they can tamper some inflation.
Well, you got a lot in that couple minutes there. So here's what I'll do. First of all, let's go through where the economy is, and since I remain positive, let's talk about what the Fed did say. They basically said, to your point, that they are willing to hurt the bottom end of the economy. And I completely agree with you that if they see a move up in the unemployment rate from around 3.5 to 4.5, which is quote unquote what they're saying they want to get, we all know that's going to hurt a certain group of people, and it's not going to be the wealthier people at the top end. And so the question is, how much of this is rhetoric? They said a soft landing is possible. And the reason I bring that up is I believe there is going to be a soft landing. And that's why, from my perspective, I'm trying to get people to focus on the fact that the markets have already discounted a lot that's already gone on. You mentioned the S&P, but let's take it further. So in 2019, we go into COVID. We print $6.3 trillion. M2 grows by $6.3 trillion. That's basically about the amount of M2 that was created from the post the great financial crisis until 2019. We did it in 2 years. Nominal GDP is the expenditures, total expenditures in the country. So we basically flushed the system with 6.3 trillion. And so far we've spent almost about 3.5 trillion of it. It's really 3.3, but let's just say we still have $3 trillion left to spend. So that means the economy, the reason I have a view on a soft landing is inflation is coming down. And this is the most important thing for people to hear because it doesn't get reported this way. CPI year over year peaked in June. Core CPI peaked in March as of now. Now, the core CPI number, which came out last week, which started the most recent fall, the monthly number came in higher than expected, and it set the expectations that the Fed were going to have to be more aggressive. And most of the core CPI, even though it was a very broad service kind of acceleration here, a lot of it was related to owner's equivalent rent. But again, it has peaked year over year since March. The PCE deflator peaked in June. The PCE core deflator peaked in February. PPI peaked in June. PPI core peaked in March. Inflation expectations across the board. 2-year tips break-evens, which basically is the market's expectation of where inflation is going. They went from 4.93 at the peak in March. They're now at 2.43. 5 years have gone from 373 to 260-ish. And then 10 years have gone from 3% to 240. And then the University of Michigan inflation expectations have declined from 540 to 4.6 on 1 year and 310 to 280. The only reason I bring all that up, those are facts. That's the actual data. And the monthly CPI numbers, forget the core, but the monthly ones that include the energy and food, they've come down sharply. So inflation absolutely positively has peaked. And then when you go back into COVID and you go, okay, so what caused inflation?
Exactly.
It was the bottlenecks. It was M2. Both of those have come down. And M2, believe it or not, is actually on pace to be negative this year. It's up slightly for the year. We don't get too many negative moves. The second quarter was the largest drop in M2 since 1980. So the Fed is pulling money from the system. Commodities are falling. Gas is falling. The bottlenecks are easing. Freight rates, which were a main part of inflation, have been down every week since February. World trade is growing at less than 1%. You mentioned housing. Housing affordability has completely collapsed. You mentioned something important. I want to separate two things. This country, only about 7% of the mortgages are adjustable rate. So the rate hike does not impact people living in a house in terms of their monthly payments. But it does impact purchases because the house price has to come down to make the monthly payment equivalent what it was. And we're talking about a 30 or 40% fall on house prices to make it equivalent. Right. But these are at inflated prices that happened during COVID. So those are coming down. Used car prices peaked in January. We heard about them last year. They're having their largest decline on record. And so what you have is a situation where all of the things that were a cause of inflation have come down. And then as we come in here today, the S&P is only up 22% from 2019. The NASDAQ, in terms of the NDX, is only up 35%. You have a scenario that's completely different than where it is. So I think we're at a very different point, and people should be focusing now on the opportunities and realizing that just like the Fed missed it last year and they should have been tightening, they're being overly aggressive because last year they were way too easy. And at some point we'll reach equilibrium, and it'll be through those real 2-year rates that you start to see a turn. And I think that's going to happen sometime over the course of the next 2 months because I think the inflation data is going to come down sharp.
That's what I was about to ask you. So as you're saying this, I'm saying to myself, okay, this is all great, but timing is everything.
Yes.
So you're right. The numbers are there. You got to ask yourself, why is the Fed pressing so hard still when we see all this data? So that's the part that I'm and just so you know, like, I don't know if you could tell if I'm bullish or bearish, but I'm actually pretty bullish right now because I'm seeing the same data. They keep talking about the CPI number, and that seems to be the focus that everybody seems to have, but there's all kinds of other data out there in terms of like gas prices, like 98 days dropping. There's all kinds of information.
Yep.
I could see that shows that we're going to get to the other side of this, right? The question is when. So you're saying in the next few months, you think that's going to the markets will stabilize and they'll try to front run this and start to jump on it.
Yeah. So here's the thing. So as of now, stocks bottomed in June. Yep. We're approaching the lows, and the way all the charts look, I would be surprised if we don't get through the lows. Earnings are coming up for the third quarter. As of now, we've seen a bump up in consumer confidence, mainly driven by gas prices come down. The ISM, the PMIs, the surveys, new orders jumped, inventories came down. We've definitely seen a less ordering of stuff by companies. We've seen Target, Walmart, all these companies have come out and talked about the fact that their inventories were too high post-COVID, and they saw a sharp deceleration. So the reason I say in the next few months is because I really do believe the data is going to come down sharply. The question is, will earnings remain as strong as they did in the second quarter?
Or guidance. The key is guidance.
Yeah, well, one of the important things is estimate revisions were going down all year, but we saw an uptick in estimate revisions from basically July into the most recent period. And a lot of that has to do, there are some companies that are benefiting from gas prices coming down because gas price is a huge part of businesses. It's not going to help everything, but if earnings come in line and we have some stability and you get the inflation data that gives another reason for the Fed to kind of, I don't want to say turn because they're going to keep raising rates, but the market is going to focus on inflation expectations relative to 2-year rates. And as long as 2-year rates kind of stop going higher, the reason we had such a large rally, because we did have a 20% rally from the lows in June into the peak in August, the driving factor behind that was gas at the pump coming down, a bounce back in the economic data, at least in terms of the leading indicators. And at the same time, this belief that I've had for some time, I didn't believe the Fed was going to remain as aggressive as they had. And that's where I started turning positive around the time that we got on there. And I thought the entire year that you should be looking for opportunities to turn. But real 2-year rates, like I said, the spread between where 2-year rates are and where inflation expectations are, they crossed over in June, meaning inflation expectations broke below 2-year rates. And once that happened, I thought for sure the Fed would start focusing on all the data that was coming through. But they've chosen to say, we want to extinguish inflation expectations. We don't want them to be ingrained in the system. And that was a mandate that really came from the White House in January when they said inflation was the biggest problem in the country. And so as long as they're fighting to make sure inflation doesn't come back, that means they also don't want stocks to go higher in the short term.
Okay. But they keep saying that their stated goal is the 2% inflation. And since we're up in the 8%, they're going to maintain that position until they can see it clearly coming down rapidly. Right now, a couple basis points it's not enough for them to pivot from their position, I guess.
Yeah, but we talk about these things. And again, we're listening to the Fed's words. They don't want to create a recession. If they can get inflation down and the economy slows down, they're happy. So I think we have to put everything into some kind of context so that people don't freak out that much. Core CPI in the U.S. in 1990 peaked at 5.2%. So we're higher than that right now. We're in the sixes for core CPI, but we were at 5.2 in 90. It proceeded to go down over the next decade into 1999, but it didn't hit 2% until about 1999. So it gradually went down, and people remember the 90s as one of the best bull markets that we've seen, and in particular for technology as inflation came down. So I don't think people should be focusing on we have to get to 2 immediately. As long as you said the path is going there, it's okay. But also remember, for people listening, right now 10-year rates are about 3.6%. In 1990, they were up at 9%. They went down during the 90s. They never got below 4.5% during the entire time of the 1990s. 10-year rates right now are way below where the expectations are for Fed funds next year. They're at 3.6, but Fed funds are expecting the Fed to peak at around 4.6%. So we have an inverted yield curve. And that just says at this point that people really, again, think inflation is coming down and that the Fed is making some sort of a policy mistake. I would say they're doing the right thing. I think they should be focused on getting inflation down, but I think the turn is going to happen way before they stop raising rates. I think it's going to be relative again to when inflation starts to bounce and 2-year rates don't get higher. And I think we're getting closer to that right now.
Yeah, and I've read something during a congressional testimony in the spring. Powell described Volcker as a hero, called him, quote, the greatest economic public servant of our era. And at least twice in the last month, he also mentioned Volcker again in 2018 biography, the biography of Keeping at It. He keeps saying this phrase. I think if you probably heard, right? Yep. During his speech at Jackson Hole, he also said, we must keep at it until the job is done. And then again yesterday, he also said, we want to act aggressively now. And then he said, and keep at it until it's done, right? So he's like we should call him Jerome Volcker, by the way, right? He's like becoming the Paul Volcker of our time. And I got to tell you, my Bitcoin friends were like, no, they'll never have the fortitude and the balls to do this. And we'll never have another Volcker. And it's like, he's echoing Volcker's comments. He's actually quoting this guy. Austin Goolsbee, I was reading about, who was the advisor to Obama administration. He commented on Volcker when he passed away and said, Volcker's mantra, that he told me one time and time again during the 2008-2009 financial crisis was that in a crisis, the only asset you have is your credibility. Inflation is the highest it's been since Volcker, right, was running the Fed, and we're facing a crisis of credibility actually right now, I think for them, because they didn't move fast enough initially, right? Yep. So I don't think he's going to back down, to your point. To your point, though, also, it doesn't mean that you have to just continue to just be worried, right? Like you can see that the markets, regardless of what he's going to do, they may move in a different direction. You mentioned something, though, that I want to bring up. Oh, by the way, one more thing, Charlie Munger, right? Obviously, because inflation is pretty important. To your point, he should do this. To your point, Charlie Munger said inflation is a very serious subject, and you could argue that it is the way the democracies die, right? So it is serious. People need to take it seriously. It could be a real problem for the economy. But you mentioned the 10-year in the 90s going to 9%. What was at that time the dividend yield on the S&P? Because I've in my adulthood, okay, so I was in high school in the 90s, right? But in my adulthood, as I've watched markets from the 2000 crash when I graduated college for 3 years, we just saw it slowly declining, and then it rose. You know, we had a lost decade, 13 years from the top of the Nasdaq, 2000 to 2013. You know, and when I look at the markets and I say we've had like a 1 point something percent dividend, is there kind of a hurdle rate that people think and they say, well, the risk free is paying me 6% possibly in the future or 5%. Why am I buying the S&P and taking on potential risks? Is there something in the stock market that they think this way about like the relative risk free rate versus buying the S&P or stocks and getting a dividend? Because I would imagine they should.
It's a good question. So let's convert for people kind of the way allocators think about stocks versus bonds. So 10-year rates are at 3.6% right now. The PE on the S&P, because the S&P has fallen 20+% this year, but earnings have grown, that means the market's gotten cheaper relative to earnings. And so we have a PE right now off of the expectations for this year, sub 20. Let's assume it was 20. So we'll actually make the market, even higher right now. You'd be getting a 5% earnings yield, meaning you've got earnings up here, the stock market. So the PE is 20. The earnings yield is 20 divided by 100. You get 5%. So we've got a 5% earnings yield. Dividend yields are somewhere in the 1.5% to 2% area. So you've got that on top of it. So if you buy stocks right now, you're getting a 5% earnings yield. As long as you assume earnings are going to grow in the future at 5%, you've got a dividend yield of about 1 and change. What's different than 1990, on top of the fact that bonds were more attractive, is the fact that you have a buyback yield too. So companies are buying back stocks at levels that did not go on in the 1990s. And right now, the buyback yield, in terms of how many dollars are going into it, it's still somewhere around 1.5% to 2% of the last number I've seen. So you get an all-in kind of yield on stocks somewhere around 8%. And you have a 10-year rate at 3 and change. Now, if you believe inflation is coming down, but it's not going to go to zero, and it's going to stay at, say, 3 to 4%, and you believe that nominal GDP is going to stay higher, well, nominal GDP drives top-line revenue, which drives earnings profits. So stocks are a better hedge against inflation than bonds are, because with bonds, you're just getting a fixed rate. So if 10-year rates are 3.5 and inflation is 4, you'd rather buy stocks than bonds. And that's why stocks are still cheap. Now, investment-grade bonds have moved up sharply. So we talked about mortgage rates. Mortgage rates as of yesterday, 30-year mortgage rates are basically at the highs of the last 20 years. That's why affordability has collapsed. Investment grade yields are above 5%. They're up at like 5.25. Since 2002, the earnings yield on the S&P, so the invert of the PE, has been above investment grade yields for the entire time, 20 years. We're getting closer. So if earnings drop off and the Fed is still raising rates, the stock market will reprice lower, because allocators will decide that investment grade bonds are a better alternative at this point to stocks unless earnings go. The point you made in the 1990s, and just how people hear it, what made 1990s such a bull market in stocks was that the growth rate of earnings was so dramatic. And that was basically Web 1.0, which brought in a lot and eventually turned into speculation. So you need new innovation to come out of a bull market. And one of the things that makes me positive is I do believe there are at least 3 innovations that I can see that are speeding up, partly because of COVID, partly because of what has happened with Russia invading Ukraine. And I think those are going to have a huge part of kind of the next phase of the bull market whenever it starts. And it's the reason why I tell people exponential innovation has not stopped. If anything, it's accelerated. You know this better than anyone. And that did not exist in the 1980s. And so the fact that we have exponential innovation, the compounding effect of innovation, people should not get bearish for too long. S&P is up 22% since 19. I think people should just be relaxing and looking for new opportunities. And I'll say, so I saw something you tweeted yesterday, retweeted from Pomp, which basically said fortunes are built during the down market and collected in the up market.
Just to be clear, that's Jason Calaconis's quote.
Oh, is it? Yeah.
Yeah, he retweeted it.
Okay. I say the same thing to my kids, that during times, unless you're not going to be alive in 10 years in your head, you want bear markets. You don't want bull markets, because in bull markets they might feel good, but you're not going to get as good a return as when you see a drop.
I will say, going back to the way I think about this. So let's take a step back. Another way that people think about markets too is they price what they think the earnings are or what they're going to be. And so far they haven't cut those earnings revisions yet for EPS, right? So the S&P. And I think, am I correct in saying it was 220 for this year?
Yeah, I mean, they haven't cut them. They're about the same as they were when we got on. I think a lot of people had higher numbers and they've kind of come down, but consensus earnings for this year are basically the same as what they were when we were here in April.
Do you think in October that starts to go down? Do you think we start seeing the company, because like the FedExes and the Fords and the Facebooks and people are going to start revising? Do you think that's going to happen in this next quarter? Or maybe it's Q1 for Q4?
I think we're probably going to see any companies that have a lot of business in Europe, and anyone that is extremely sensitive to China. One of the big changes that happened this year. So, I just did a fireside chat with Ed Hyman, who's kind of the head global economist leading in all research things in terms of votes. And he and I did one last year where we both agreed that the Fed was wrong and the market was wrong, that inflation was going to be structurally higher. We just did another one, and both of us are now on the other side saying that it's obvious that inflation is coming down. The Fed seems to want to create a problem. The risk is whenever we see this kind of rise in two-year rates that you will get eventually a problem. The reason I go back to the inflation stuff on this and talk about it, there's a lot of things that happened this year that I didn't expect that are going to have an impact on the way inflation happens and growth. What's happening in China, and I tweeted about this yesterday, I mean, their economy, they can't get people to buy houses over there. This has been a massive drop-off in local confidence in the housing market in China. And without buyers coming into the housing market, you can do whatever you want. Housing is the most important asset in China. And so their nominal GDP is low. Russia invades Ukraine, and we get a massive spike in their local power prices on the back of natural gas prices, on the fear that Russia is going to shut off, which they have, gas into Germany. And so all of these things that kind of went on, the housing market changing, the Fed being more aggressive, we just kind of shifted everything dramatically. And so to give you back what I said about no hard landing, because I think it's one of the important points on this earnings front, if we have a hard landing, you're going to see earnings drop. I think for companies that have a lot of their earnings overseas in Russia, in Europe and in China, they're probably going to see disappointing earnings. The question is, how much of that is already built in? I think we are going to see a slowdown from earnings in Q2, but year over year earnings for the second quarter were up close to 8%. Revenue was up close to 14%. So even if they drop off, I don't think it's going to be a major collapse. And with gas prices coming down and input costs coming down, PPIs coming down and CPIs not coming down as fast, I think there's a scenario here where earnings are still going to hold in there better than what people think. And again, I say this a lot, but I'm going to use kind of a football analogy. The immune system of the economy is extremely healthy. So if you want to kind of think about what that means, we printed $6.3 trillion. Bank deposits are still $3 trillion higher than they were before COVID. Some of that money is in individuals' hands. Some of it's in companies' hands, and some of it's in state hands. We have a lot of stimulus still to come out over the course of the next 3 years, and that's an immune system thing. That just means it's hard. The credit situation, yes, rates have gone higher, but almost every corporation refinanced their credit to much lower yields. Home buyers, they're not suffering because they have fixed rates at much lower. There's no more refinancing going on. This is not a systemic issue. And so from a football perspective, basically, if you've got a team and all of a sudden your 10 best players get injured for 2 weeks, the spread's going to shift dramatically and you're going to be an underdog in all those games because you're missing your 10 players. But the structure of it's fine. Once they come back, everything's good. And that's what's happening now. We have inflation right now. Last year, the Fed let it go too far. They're aggressively getting it in check. And at some point here, I think the stability of the earnings and the stability of the economy is there because we still have a lot of stimulus. And that's why I remain overall positive and think the next move that matters for people in terms of investing is to be focused on looking for opportunities on things that are going to accelerate out of this gloom
Yeah.
situation.
I keep telling my friends, I don't know what you feel about this particular symbol, but the NASDAQ, the Qs, TQQQ with the 3X leverage, I'm like, you could kill it over the next couple of years on this right now. I mean, if you believe you're going to get to the other side of this.
I'm not as I don't think I think large cap tech, mega cap tech is going to have a really hard time in the next 5 to 10 years. Now that may sound
because they were overinflated over the last few years. Is that why?
Partly because they were overinflated, partly because I do believe the labor shortage that exists in the country is going to keep inflation up near 4%, which is not bad. Core CPI can be lower, but regardless, I think inflation going, as you said, from around 9 down to 4 is very positive. But I think this is a different kind of situation. This is an infrastructure spend. I think energy prices, although having fallen, I think they're going to stay in the 70 to 130 area for oil. That's extremely positive for the energy stocks. We have a supply situation that is an issue in energy because of the underinvestment from ESG. I think the main problem for mega cap tech is what I expect to have happen in Web 3.0, and I expect it to be a major disruptive force, especially for the platforms. Since we spoke, I had already spent a lot of time over the prior 6 months on this whole concept of how I think of the blockchain in Web 3.0. That has only accelerated as things have gone down. The same chart I sent out today, which shows an overlay between inverted real yields. So as real yields move higher, the S&P goes down, and it's a direct overlay. It's broken apart since June. It argues that the S&P should fall significantly over the near term. But Bitcoin is the exact same chart. So if you instead of focus that Bitcoin is a hedge for inflation or Bitcoin does when money supply grows, the reality is they're no different than tech stocks. I mean, it's the next innovation. I just think coming out of it, in fact, I'll give you some numbers. I gave you the S&P and the NASDAQ since 2019. I hear everyone complain about what crypto is doing. Bitcoin's up 165% since 2019. Ethereum, which to me is the most important part of the disruption to the mega cap tech stocks, that's up 1,000%. So for anyone that's looking for investments that are going to accelerate out of here, I would start with the blockchain and Web 3.0. And I think the growth that we've seen in the number of cryptocurrencies to go from 66 in 2013 extended into where it is now, which is about 20,000 with about 10,000 deactivated. That's basically meaning we're starting to get companies that are growing because those cryptocurrencies, a lot of them represent disruptive forces. And so that's going to grow. We have about 50,000 public companies across the globe. And so I've kind of termed this Web 3.0 blockchain world as there's a totally separate country that's being born. It has its own currency, Bitcoin. You have the fiat world over here, and more talent and money continues to go there. But the fiat world is still about $425 to $450 trillion of assets. Huge. Versus $1 trillion in the crypto world. And I still think that country, as I'm calling it, is going to see more talent and more money come over the course of the next 3 to 5 years. And I think both of those situations, the talent and the less centralized world, they go strictly against mega cap tech.
What do you think of the SEC stance and Gensler on Ethereum? They made a comment the other day, and I'm sure you saw. And what are your thoughts on how aggressive they may be on the crypto market, not Bitcoin? Obviously, he views that as a commodity, and others as an unregistered security. So, how do you think that may play out?
I've always had, I think, a view which is similar to the religious zealots of the Web 3.0 world, which is more regulation is needed, and we need the government to basically focus on it. It'll bring more people in if the rules are clearer. Really, at this point, it still kind of fears that we don't have the rules, so you don't know what they're going to be. So this is kind of like the Fed jawboning. So I would treat it the same way. A lot of this is just to remind people not to speculate, not to do anything that will get you in trouble. And I think that's what they should be doing. But I really do believe that this is going to continue to accelerate. And when something like the merge passes as a sell the news event, I think that's a positive. I really do. I hear a lot from allocators, and I gave a presentation called The Future of Money, Crypto. And this was large allocators across the globe. Most of them, again, I'd say the average age in there was around mine, which means about 55. These are not people that are that savvy on kind of what's happening in Web 3.0 and the blockchain, but they have most of the money in the world. So that age bracket and higher controls about 70+% of those fiat assets. And so they're the ones that matter a lot towards the transition over there. And I basically talked them through it. And the main questions that got asked were about the energy efficiency and the ESG side. And I think that's one of the important things of the merge. everyone is so ESG focused that anything that is energy inefficient, I don't care what it is, it makes allocators kind of roll their eyes a little bit. So some of them are extending in there, but I think the Gensler comments and all this, I think in the long run they're good. I just think we have to kind of get through the time where the assets start going up again, and then people will refocus on this from the investor side.
Yeah, we're probably a year or so away from that as you go into the next halvening. But so when you look at the proof of work versus the proof of stake, which is the ESG arguments and stuff, I would say the argument is that the proof of stake is a problem because the most money then can control the blockchain, whereas that's not the case with proof of work. What are your views on that? And by the way, I was just having a discussion with a friend of mine. He has like 100 and something Bored Apes. This guy's killing it. But I made a comment in a text message to me the other day, and I said, obviously, the merge, as he's calling it, right, to go towards proof of stake is really just trying to bend the knee to this energy FUD argument, which is really not good long term for decentralization of the blockchain for the Ethereum blockchain. What are your thoughts on that?
Well, here's the thing. First of all, on the proof of stake, when I first started to look at this, and again, the fact that I even know anything about this compared to 2 years ago is a testament to my interest in it. But I started with insurance companies, and particularly life insurance companies, because we do a lot of business with them. We have a lot of investors there. Their big complaint was the fact that there was kind of this inability for them to post money so that they could kind of be doing their business on the blockchain, and that they wanted to have something, because obviously an insurance company, they need to hold lots of cash. They need a yield on it. So for them to actually start businesses with inside the blockchain, believe it or not, proof of stake is really important. The ability of having to put money in something and get some kind of yield on it. You mentioned, and I think it's true, that this has the problem of, okay, people with a lot of money start coming in.
Or sovereign nations.
And they start coming in big size. But I just continue, when I hear anyone start to pick out minor points of what will happen in the ecosystem, unfortunately for everyone, there's always going to be a part of capitalism that is a part of this new country or this new world. They're going to run parallel to each other. There's no way the world's going to go to a completely decentralized world. That's why I say less centralized, because when I look at the things, I just think every day more people are going to shift over there below the age of 50. And I think it's going to happen consistently. I don't think any of the people, or very few of the people above the age of 60, are going into this world. I just don't think it's going to happen. Demographics will end up shifting their money back to younger people, and gradually those people will end up, if they're not healthy, and we'll talk about this if you want, but one of my big innovation things that fits in with this whole point is the transition from lifespan, which is what we've been doing for the last 200 years, is extending life. But over the last 20 years, we've seen the rise in diabetes and all kinds of diseases. That means at 65, people are not getting any healthier, meaning a 65-year-old today is no better off than a 65-year-old back 20 years ago. They can live longer because of drugs and because of medical treatment. But what we're entering into now is anyone that's below the age of, let's say, 50, and I'm trying to keep myself biologically below the age of 50 with a bunch of things. If you can stay below that, the cutoff point, with messenger RNA and CRISPR technology, software for the body is going to start to enter where we're going to be able to basically hack a lot of things and allow you to be healthier longer. That has implications for the labor shortage. It's one of the reasons why I think it'll have huge amounts of dollars. But these 60-plus-year-olds, like I said, they control most of the world's money. And so what's the number one thing for someone on 65? They want to live a healthier life. And so they're going to spend money on these things. They're going to be involved in it. They're going to go into the hospital. And these things are happening. And so I just have this belief, when you think about everything going on with crypto, the demographic issue, which has a lot to do with the health span and the money coming out, these two places, they really directly go towards the labor shortage. And that's something I believe in. And that's why, regardless of all the minor things like Gensler, proof of stake, is it going to be there? I think these are just all the questions that are asked with any new innovation that people are scared of. People didn't want to take the vaccine. There's all kinds of things. And I get it. When new technology comes in, people are always scared of it.
Well, I mean, it's a little more than that, right? Like Satoshi Nakamoto, whoever it was, really created Bitcoin to be decentralized so that it doesn't have government intervention and monetary policy issues as we're seeing. And if you have a proof of stake, you do have there's the risk that like a nation could just start printing money and buying up the coin and then get control of the network. So I think it's a low risk that would actually happen, but it could, right? And with Bitcoin, it actually can't. I will tell you this though. It's funny you mentioned insurance company. I'm an investor in a company called Anchor Watch. I was a pre-seed investor in this, and it's insurance for self-custody Bitcoin. So you take your Bitcoin, you take it, and if you lose your keys, they insure it. And there's actually a yield for investors to go into this thing as well, which we could talk offline about, just to maybe get some introduction to some of these insurance companies for those guys. But I think you'd find that business very interesting, and because it's on Bitcoin, right? But they're probably going to insure other things in the future. That's not the intent, but their company, right? It's capitalist, it's running it. But there's a yield opportunity for that as well. So there are yield opportunities, I think, for Bitcoin that don't have to necessarily be such a bad thing like we saw with Celsius and others.
Nothing accelerates something in terms of getting groups of people that control large masses of money faster than the ability of getting a yield. Nothing. Yeah. So if they can get a yield above where they can get it in the marketplace, you will attract there. So I think the stablecoin situation that went on scared a lot of people. I still believe that the yield portion of this is extremely attractive for older people to move into this. And even if they only put 5% of their money into it, that is the way that I think they'd rather go into it, because it gets rid of the volatility that's sitting in the space, because it translates the volatility into a yield for them. And that's what they want.
Hey, listen, Marc Andreessen says software is eating the world. Can't argue it. Right. Jordy, thanks for coming on the show today. I really enjoy having you on, talking about the markets, and this year, obviously inflation, but in the future, probably new things as well and new topics. Why don't you tell everybody where they can find you? I'm going to put that in the description for everybody as well, and on the screen.
Yeah. First of all, thanks, Jay. I really do enjoy this. You kind of inspired me a lot after the conversation last time to spend a lot more time on crypto and Web 3.0 and the blockchain. And so each time that I spend time on it, I kind of think of when we went on this together. People can find me. I tweet about the markets regularly, 4 or 5 times a day. There are only charts that I see that I think are interesting that help visuals explain what's going on. So they can find me at jvisser_Weiss. That's WEISS. That's the name of the firm. I do a lot of videos of the markets. If people really are interested in the markets, they can go to the website. It's gweiss.com. And then you'll see a lot of content there. And then we do a weekly podcast where I also talk about the things. We keep it at 20 to 25 minutes, try to give the most latest news, not just on the market, but we talk about macro stuff. We talk about crypto, and the name of it's In Search of Green Marbles. So those are the places where people can find me.
And I will say, I encourage everybody in the crypto space, in the Bitcoin space, you should subscribe to the newsletter for Weiss. I'm a subscriber. You get the real time with Jordy Visser. I got to say, one thing I really think is really cool about your video is that like 5 minutes in or whatever it is, 2 minutes in, it says, put in your email address. It's like at that point you got to do it because you want to finish the discussion with Ed Hyman or whoever it might be, right? You're like, come on, this guy's got me. But it's a great podcast that you guys put together. You have a lot of charts. It's a lot of data. It's very data driven, which I really like. And I think everybody would enjoy that that's watching this show. Because let's be honest, today Bitcoin is a risk on asset, and it does correlate with the S&P and the market. So you should understand markets and macro as well.
Yeah, you said something important, and just so people really get to know me, my father told me at a very young age that everything I hear is a story, and to focus on facts and then merge the stories in with the facts. I think people read the newspaper and they think it's a fact. The opinions on the markets by everyone, including me, they're just stories. I'm trying to use facts and then listen to the narratives that I'm hearing. And when I hear the narratives tilted one way and I see the facts tilted another, the best way for me to do it when it comes to markets, in the markets, you're never picking on the money line of a football game. You're picking on the spread. And a lot of the stuff is already built in. So the multiple of the S&P is the spread of a football game. And right now, I think looking forward 6 months, the highest likelihood from here is that you're going to continue to get earnings. You're going to have the GDP, which will slow, but not go into a hard landing. And if that's the case, you got to kind of go through the volatility and suck through it. And then 6 months from now, I think you'll be seeing higher prices. I thought that 3 months ago. So for those of you, my story hasn't planned out, but I think going forward it will.
The timing is the issue, right? When I was talking to Bill before, I was telling you, Bill, and he goes, well, you got to ask him. And he goes, well, let me find it. You already told me, so I don't have to ask you, but he's like, you got to tell, he's like, timing is everything. What's his timing for being bullish? And this is the thing with the analysts. He's like, I've been on Wall Street for 40 years. He's like, they'll tell you it's going to get better. It's like, when? I want to nail you down on the timing. And you said it in a few months. So to your credit.
The number one indicator for me to watch is going to be real rates. Already, we've seen beta outperform quality companies or profitability since June. So from a factor basis, and this is kind of inside baseball stuff that I watch and I talk about in the webinars, but we've already seen some risk taking happening since June. And even though the market's gone down, we're getting divergences. And whenever I see divergences, that's what the title of the podcast, In Search of Green Marbles. I'm looking for those marbles, which are data points, which are leading indicators, which are turning. People focus on the things they read in the paper, and I just don't believe that. So we're already seeing it. Yeah, exactly. So.
Yeah, I can't stand when people show me all these charts of like, oh, by the way, I want to ask you this before Hop. This is a heated discussion, and I have it with a few of my Bitcoin friends. And Jeff Snyder is like, they're like disciples of Jeff Snyder. They just, everything he says, they believe. And he says that the Fed doesn't matter. It's irrelevant. This, and I don't really believe that. And then they'll show me a chart and they'll say, look, the rates in the 10-year moved, and then the Fed did what he did at the meeting. I'm like, yeah, but he signaled that already, and that's why the market moved. So I'm of the opinion that the Fed's rhetoric moves the market then to get them comfortable what's going to happen, because it's all about managing expectations. My mom always told me, happiness, the key to happiness with your wife is managing expectations, right? And it's the same thing with the markets, and the Fed totally does that. So they put out the news, they leak it in the papers, the Wall Street Journal, whatever, or they say things at certain meetings like Jackson Hole, and then they do what they do, but the market moves, and then they'll say in the data, oh, no, the market moves the Fed. And I'm like, no, he signaled that through the Fed governors or himself. What's your view on that?
So there are times where the Fed isn't really, they might say something and the market completely ignores them. And then there's times like now where I completely agree with you. So I think there's no hard and fast rule on this, because sometimes if the range of inflation for a year is 2 to 3%, there's not a lot of things to pay attention to. The problem is we're still coming out of COVID. And that's the thing I say to we have 20 plus portfolio managers here. They are frustrated beyond belief because hedge funds have been deleveraging. We run a market neutral strategy, so we don't care about the direction of the market. But what has happened this year is like every time there's a false start, the Fed just comes back and says, oh, no, we don't want stocks going up. We're going to go nom down. This is not normal time period. We're still in the post-COVID period. We've been in a time of uncertainty since 2019. This is just a different year of uncertainty, but the last 2 years were about a pandemic. This year is about trying to rein in the money supply and the inflation. When we get out of this year, it will be a completely new year. And the people that I talk to at pension funds, they have a job to do. They have to put money to work. And almost everyone's been sitting on their hands now for close to 3 years. So I think you're going to get back to a point where we'll go back to the other side, which is the Fed's not going to say much and the market's going to do whatever it wants to do, because the Fed is very seldom right about the future, almost never. And right now, to make sure they're right, they're saying inflation's going down and we're going to shove the money through this. We're going to make sure it goes down. So I think you're right on this one.
Yeah, I will say this: the 2019 comment, right? I feel like I had Jeff Booth on, the author of The Price of Tomorrow, right? And he's like, "Listen, we don't have an inflation problem; we have a deflation problem because of the technology companies, and it's creating deflation. And then the Fed's monetary policy is essentially trying to combat that, right? They're printing the money over time to try to kind of show that we have growth, but we really don't have growth," is his argument. I don't know what you feel about that, but I sold my company in 2015 because we started the company right before the great financial crisis, my last tech company. And in 2015, I was like, bull markets are like 7-8 years, typically somewhere in that range. So it was like 2007, 2015. We sold the business 2015. And then 2015 was kind of a flat year. And I was like, wow, I timed this one perfectly. And then Trump gets in office and says tax cuts, and shoof, it goes flying up, right? The markets. And so we didn't get that bear market. And then you had the 2018, you have the taper tantrum and it drops down in December. And then in 2020, we had this again. To your point, we just keep doing this whipsaw up and down. But I feel like it's been a long time coming for this bear market, obviously with the longest bull market in history, right? And I look at that and I say, is it really 2019 since, or is it 2015, or is it since 2009? Right? Like we really have a major problem out there.
This is a good place to kind of take it. So the comment about deflation from technology, the last 2 years I was all on inflation, and then I started this year off saying I just want to remind everyone at some point this year I'm a full-blown deflationista. I believe that exponential innovation started in the 90s, but really the birthplace, and this is something that if we didn't talk about on the first show, I think it's a good thing for people to go look up. So we mentioned Paul Volcker, the greatest public servant in monetary policy. So when he went aggressively on rates in the early 80s, there was talk of him being the Time Man of the Year. And what ended up happening was the computer ended up that year being the Time Person of the Year. Since that time, and Steve Jobs was angry that he didn't get it that year. That's another story. But the computer was the Time Thing of the Year. That is the beginning of exponential innovation. And whether you go through Moore's Law, whether you read stuff by Ray Kurzweil, whatever you want to believe in terms of where you think innovation is, there is absolutely no way to refute that inflation was going down in a fairly linear line and 10-year rates were going down. I believe that's a combination of demographics and exponential innovation and the enormous amount of debt that we still have existing in the world. And so I will remain a deflationista. And to your point about COVID, we got inflation because we printed money and we locked everyone in their house with a phone where they could still order things. That's why we have inflation. People spent trillions of dollars in a very short...
Yeah, we would have had a recession otherwise.
Exactly. And so we fought it off. So we had to get some negative thing because there's no free lunch. And the innovation is not going to save us from that amount of money that went through it. And I keep talking about it, but people should really understand that since 2019, not only do we have $3 trillion left for people to spend, we've had an increase of $27 trillion in net worth because of the housing market. That's why the economy is still fine. The reason I think inflation is coming down is because we're unwinding all of the COVID stuff. Europe has slowed down, China slowed down. That'll keep things there. And the Fed raised rates so aggressively that we're going to see growth slow, and it'll be spread out over the course of 4 years. And then exponential innovation will take over, and deflation, in my opinion, is the bigger risk once we go through it. I completely agree.
And it's funny you mentioned so on the mortgages, right? You said earlier you thought about 20 or 30%. That's kind of where I'm at too, and it's a very simple thing. You guys can go on your computers right now and just type in simple mortgage calculator, and then Google has its own version of it. You type in $100,000, 30-year rate, 3.5%, $449, right? Okay, if you increase that to 6.5%, it goes to $630. So for you to get there, you got to go down to like $70,000. It gives you $442,000. That's the exact math right there, right? So it's literally just math. It's not complicated. And when you talk to realtors who are talking their book, or you talk to your friends who's looking at his home equity and doesn't want to see it going down, they're just burying their heads in the sand. This is math. These prices will come down on real estate. But to your point, they've gone up so much, it really doesn't matter. It's all phantom gains on paper anyway.
Beauty of the fiat system is if you have a town with 1,000 houses that are each worth $1 million, and one of them trades at $2 million, and there's no other houses on the market, they all go up to $2 million. And then when one person comes in to sell and they sell their house at $1.5 trillion, all the other houses are marked down to $1.5 trillion. It's the beauty of the Ponzi scheme. It's what we all live in. They went up because of COVID. There was a shortage. Now we move rates up. So to your point, you're going to see house prices come down 20 to 30% in many, many parts of the country. There's still areas where I think the blockchain and taxes are dominating the supply situation. But where I am in New York, New Jersey, I think house prices have peaked over here. So.
Oh, I think so too. I'm in Jersey, as you know. So yeah, I mean, I can tell you my house is going through the roof, and I'm like, I don't believe any of this stuff. And I have people on my block selling. I go, where are you going? Like, we have a beautiful location. I'm like, I'm not losing my location over a short-term hit. You know, these prices will come back over time. I'm not worried. Jordy, thanks for coming on. Appreciate your time today.
Appreciate it, Jay. Thanks.